All right, types of insurance. We're going to skip right into the notes here today. So, first of all, why is it important to have insurance? We're going to start with a few examples to explain this. You have some amount of risk in your life, a chance of loss from an event that cannot be entirely controlled. And so you manage that risk with some emergency savings, at least 6 months of expenses that you've set aside to cover costs of unexpected expenses. But also, you want to have some insurance. And insurance is a financial product purchased by many people facing a similar risk. So, your health insurance, a lot of people are facing that similar risk of something going wrong with their health. And you purchase that to protect against the risk of larger losses. So, if you've ever known anybody who had a major illness or an accident and they had to be maybe uh, transported by ambulance or helicopter, or they had to stay a while in the hospital, you know that it could cost tens or hundreds of thousands of dollars for those bills. So, having insurance significantly reduces the amount that you would have to pay in that instance. All right, so talking about some definitions about insurance policy. The policy is just the product that you buy. It's a contract between the insurance company and the insured, which is you, that states the exact terms of that policy. The coverage describes the risks that are covered and the amount of money that will be paid for losses under your specific policy. So, how much the insurance company will pay and under what circumstances. The policyholder, that's you, is the person who owns the insurance policy, and a premium is normally a monthly amount. Sometimes it could be every 6 months or once a year, depending on what type of insurance and the specific company that you're going with. But a premium is the amount that you pay on a regular basis in order to have the policy. All right, this one is not on your notes, but just an illustration of how insurance works. So, suppose there are 100 people in a health insurance group, just 100 people who are all living and working and doing something similar. There is a 1% chance that any one of them could get sick and require a $10,000 medical expense. No one knows who will get sick, but if each person pays $100 into a pool, they will collectively have $10,000 to cover the medical costs of the person who gets sick. So everyone gives up $100, but nobody gives up more than $100. Everybody puts the same amount in there, and then therefore, the 99 people who do not get sick are out $100, but nobody is out the $10,000. So you're purchasing peace of mind in knowing that if you are the one who gets sick or has an accident or something bad happens to you, that you will be covered. And all the people who are paying those insurance premiums are doing so that that money goes into a pool in order to pay for the people who need it. It shifts the risk of big loss from the individual, you, to the insurance company. So, talking about benefits of insurance, these are the types of insurance over here. That's not what goes in your blanks. You're looking for this part over here. You get payments from the insurance policy, and those can far exceed the premiums paid. So if you are paying, for example, $100 a month just to have an insurance, but then you have a major loss, like your house burns down, that could be $150,000 that maybe you've lost. And so usually the amount that you get back is going to greatly exceed the amount that you have put in. So that is one of the major benefits of insurance. And it also just provides you with some financial security and peace of mind. You're never going to have to experience that significant financial loss. And you just have peace of mind knowing that you're going to have everything kind of taken care of if something bad happens to you. All right, page 2. A few definitions on this screen. Talking about the insurance process, first of all, here an event occurs resulting in a loss. So, for example, a major illness, an accident, a home loss, whatever it is, it results in loss. And if you did not have insurance, you would have to pay for that loss out of your pocket. But since you do, you are going to make a claim to the insurance organization. And claim is just your formal request. Usually there's a form that you fill out, basically asking the insurance company to pay for whatever it is that you've lost. Then the insurance organization is going to determine if the event is covered by your policy. So, is this specific thing that happened to you something that was listed as a covered disaster under your policy? And then we go here, sorry, if so, the policyholder pays a deductible. And a deductible is the out-of-pocket money that you have to pay first before your insurance is going to kick in their part. Typical amounts of deductible could be $500 up to $2,500. It depends on your insurance policy, but that means that that's the amount that you have to pay out of pocket first before the insurance is going to pay anything. The remaining amount after that deductible, after you've paid your deductible, is now subject to what we call co-insurance. And usually your insurance is going to list a certain percentage of that big amount that you also have to pay. So just having insurance usually does not mean that you don't have to pay anything. You will usually be responsible for a deductible and also many times co-insurance. So here's an example just to show real numbers. Louise has a health insurance policy with a $500 deductible and 20% coinsurance. So that means that she's going to pay the first $500 of any medical care that she receives, plus 20% of anything above that $500. So if she is in an accident that results in a $5,000 medical procedure, we're assuming it's covered by insurance. She's going to pay 500 because that's her deductible. That's the first part that she has to pay. And then the remaining $4,500 of that medical procedure is subject to that 20% coinsurance. So she's going to pay $1,400 more. And then the insurance company will pay the remaining $3,600. She's still coming out ahead. Total, she's got $1,400. Or I think that was including the 500. Total, she's at 1,400. She did not have to pay 5,000. So yes, she's coming out ahead, and most medical procedures are going to be much more than $5,000. Another example here, Carlos. Can't get myself out of the way there. Carlos was involved in an automobile accident that resulted in 3788 worth of damage to his car. Random number. How much does Carlos pay and how much does the insurance organization pay? So we have to know what's his deductible. And it says here that he has a $500 deductible and he has 0% coinsurance. So that means Carlos is only going to have to pay $500 because of the deductible, and therefore the insurance organization would pay the remaining $3,288. So now that you understand, hopefully, how deductibles and coinsurance work, let's look at two policies and comparing the two and seeing which one is actually the better deal or whether there's just pros and cons. And usually it just depends on the individual. The premium, that means how much you're paying per month. This policy is $300 per month. This one is $200 per month. Deductible amount. So if something happens, this one means you are out $200 first. This one means you're out $2,000 first. So you can already see a little bit of a pro and con here. Yes, it's less per month, but if something happens, I'm going to have to come up with a bigger chunk of change. Coinsurance amount, 20% is what you would be responsible for the remaining amount of the whatever it is that you've lost. Therefore, the other 80% is going to be paid for by the insurance company. In this case, you owe nothing more. So low monthly payment, high deductible, you're going to have to pay $2,000 anytime anything happens, but that's all. You would pay nothing more than that. In this case, you're paying more every month. If something happens, you're not having to pay very much, but then you are responsible for 20% of the remaining balance. Now, most of the time, the answer is this unclear. It just depends. If you're someone who goes to the doctor regularly, you may prefer this one so that you are only having to pay $200 for any kind of procedure that happens, or even just $200 per year. But then you're going to have to pay above that a little bit. And you may pay more per month just to have the ability to pay only a $200 deductible. Whereas if you're not someone who goes to the doctor very often, you might prefer paying less per month and know that, okay, if something major happens and I have to, I'm going to have to come up with $2,000, but then I'll be done. So it's just a matter of pros and cons. So finally, we're at the next blank, which is, why do insurance policies include deductibles and coinsurance? Why can't they just pay it all? Why can't we just have a set premium and then we don't have to pay any more? Well, it reduces the problem of something called moral hazard. So here's an example. If you don't lock your car or you park it in a theft prone area in hopes that it will be stolen and your car insurance will pay for a new car, that presents a moral hazard. And so now you're trying to get rid of something in order to receive the insurance benefits, or burning down your house so that you get the insurance, or I'm not even going to go there. But when the act of insuring an event increases the likelihood that it will occur, um, then people are going to have that moral hazard issue, and maybe they're going to be more likely to do stupid things just to get the insurance. So deductibles and coinsurance put some of the loss on the policyholder. They give you some of that financial responsibility so that you're less likely to do the stupid things. They are not intended to make a person better off than before the loss happened. They're supposed to help you regain your financial security, not make you better off. Sources of insurance. So the next slide is going to tell us what to write on our next blanks, but you have individual, employer, and government as potential sources of insurance. You can buy insurance by yourself, go to an insurance company, insurance agency, and purchase insurance by yourself. Your employer may offer some insurance that you can purchase through them, and there are also government programs that allow us to get insurance. So, looking a little closer at the employer provided insurance, which is two blanks on your sheet. Employee benefits describe products or services that add extra value to employees beyond your wages. So, insurance is one of those things. It allows you to have potential loss paid for at maybe no expense to you or a smaller expense to you. They're paid for by either your employer or you, or both of you together. And this is defines in-kind income, a donation of a product or service in place of cash. That is what your employer is doing for you when they provide you with insurance, or they provide you with the opportunity to purchase insurance at a reduced cost. Policies might be available to your family members as well, but usually you have to pay extra for those. Government programs, these are going to provide basic insurance as part of the social safety net to protect citizens from economic hardship. Oops, sorry, where am I? I had to sneeze, but it didn't work. Okay. So things like Social Security, Medicare, Medicaid, these are things that are helping you to pay for times when something bad is happening, you don't have enough finances to cover stuff like this, and especially not to cover a major loss if that were to happen. So many programs like unemployment insurance and workers' compensation, those are both there to pay for You pay your way or pay for a major loss in case it happens. Require a work history and employer provided participation in order to be eligible. These government programs can also um, be for just specific catastrophes like hurricanes and um, this says Hurricane Sandy, but I think also Hurricane Katrina or wildfires or any of the major things that happen that we have no control over. All right, now we're on the third page where we're going to go over briefly all the different types of insurance. So the first one, health insurance, and the definitions right here. It provides money to pay for health care. Now, this can be provided by any or all of these people, employer, government, or individual, any combination of those things. And this is going to cover any or all of the things below here. So, doctor's visits, hospital bills, maybe vision care, maybe dental care. Um, and one thing that's important to note is that if you don't have the ability to come up with money very easily, health insurance is going to be very important for you. Never know when something is going to happen with your health. Disability. So when a person cannot work or live independently, they may be able to apply for disability insurance, and this is going to pay to replace their earnings. So a paycheck that you're going to get during times when you cannot work due to an illness or an injury. This is typically provided by employers or the government, but it's also technically provided by you because you are paying into uh, the disability insurance pool when you purchase a policy and you're paying premiums. Long-term care insurance is paid for whenever you need like extended nursing care, if you need to go to a nursing home, or even if you're in an accident and you have a long rehabilitation, something like that, where you cannot live independently, but don't necessarily need to be hospitalized. And those are provided by individuals. Those are optional. Those are not provided by anybody. Nobody's going to make you have long-term care insurance, but that's what it's there for if you decide to purchase it. um, Property insurance. This is this covers a wide variety of types of insurance, but property insurance is for anything that you have that you own. Okay, so homeowners insurance, renters insurance, automobile insurance, those are all property insurance. And this is going to pay you if your property is damaged or destroyed by an accident. So this is where what would go into effect if your home burns down or floods, and if you are in an accident and your car is damaged, then that is where property insurance comes from. Now, liability insurance is paying other people who were involved in that scenario. So you're in an accident with another vehicle, your liability coverage pays for the other person. Um, oh, what else? So in this case, property insurance pays for you and liability insurance pays for others. And these are both paid for by the individual. So, different types of property and liability insurance: automobile insurance that pays for your vehicle, homeowners insurance that pays for your house, or renter's insurance if you are renting your house. You are required by law to have liability insurance so that if you get into an accident, the other person is taken care of. You're not required to have regular property insurance, but most people would say that it is smart to get both. Life insurance, move out of the way a little bit there, is the last one here. So life insurance pays uh, a payment to beneficiaries who were named by the insured person. Here's what that means. So if I have life insurance on myself and I pass away, it would pay payments, regular payments to whoever I decide is my beneficiary. And a beneficiary is the person who receives the money if I die. Typically, that's going to be a spouse, but if I didn't have a spouse, it could go to my parent or a sibling or whoever I designate maybe to take care of my children. And that would be my dependents, people who are relying on my income and my care. Life insurance can be paid by employers or individuals, sometimes both. And it might cover paid and unpaid work formerly done by it, the individual, me. And think about when it would be necessary to have life insurance. Yes, if you make a lot of money and you die, then your family needs a replacement income. But even if you are a stay-at-home parent, you are still providing household production income. You are providing unpaid work like childcare, meal preparation, and whatever else you do in the home. You are providing something that, if not there, your spouse or whoever's left would have to pay for. So it is smart for even people who don't have income to get life insurance because whenever they pass away, it is going to be important to replace those valuable things. I think that's it today. See ya.